So last week we saw investors really waiting for the non-farm payroll report to come out on Friday. It really was, let's see these numbers, because Powell was talking about the importance of the labor market, so investors were also focusing on that as well. We got a prelude earlier in the week with the ADP numbers coming out. They were a little bit worse than expected for their employment report. And then we had the job openings come out, the JOLTS, and they were a little bit worse than expected. And then Friday was an absolute disaster for the non-farm payroll report. First of all, if we take a look here at the unemployment rate came in at 4.3% as expected. But if we take a look at the non-farm payroll report, now previously for July, the non-farm payroll report came in at 73,000. And the expectations was for 75,000 for August. It came in at 22,000. That's a huge miss, but it doesn't stop there. Well, just how bad were the non-farm payroll reports? Well, if you take a look here, they came in below the expectations of 79 out of 80 of the forecasts. That is a big miss. If we take a look, there's a lot of details here saying, look, for instance, the full-time jobs numbers, there was a loss of almost 360,000 versus part-time, which was almost up 600,000. We can see that here. The red is the part-time and the green is the full-time. So in other words, yes, we saw a slight increase for the number of jobs, but it was all part-time. So the non-farm payroll report counts each part-time job as a full-time job. It's kind of crazy, but that's the way they do it. So these numbers were quite inflated. It wasn't just the August report, it was also the revisions that took place. We saw 27,000 jobs being lost in the month of June. This is the first negative month since the pandemic. That's huge. The U.S. economy's lost 142,000 jobs over the last 4 months. This is making the labor market much weaker than it appears on the surface. This is quite concerning because if you take a look at the unemployment, the young people are really having a difficult time in the States. Their unemployment rate is at 10.5%. These red bars here represent the recessions. You typically see the unemployment rate for the young people start to tick up as the recession starts. Well, we've seen the unemployment rate rise for this group of people, but we have not seen the recession hit yet. Now, I got to say that this is in the States. Canada also has a very similar situation. The unemployment rate's ticking higher. We'll talk about that. But it's a young employment sector that's really having troubles. So where do we stand as far as the Federal Reserve cutting its federal funds rate coming up shortly? If we take a look here, we can see the current rate is 4.5%. And here the next meeting is September the 17th. The odds of a rate cut are 111%. Now, how do you get 111%? You know, we were always told when we were younger, you have to give it all. You have to try 110%. Well, you can't go above 100%. But in this case, it refers to now that increases that 11% goes towards a double rate cut on one day. That's not likely to happen, but that's really what it's reflecting. And you can see here that in Canada, let's just skip across Canada, the current rate for the Bank of Canada overnight rate is 2.75%. The odds of a cut are about 75 basis points, so 3/4 probability that they'll cut on September the 17th, on exactly the same day, by the way. So more likely that the Fed will cut than the Bank of Canada, but likely they'll both cut. This graph from Morgan Stanley, the red line shows the Federal Reserve expectations previously to cut rates. The gold line shows the current probability from the market, and the blue line is from Morgan Stanley. And here you can see that they've got this step down, and we're looking at the by the end of 2026 a upper bound rate of 3%. So that is quite a bit from where we are right now. Okay, so it wasn't just the US that had disastrous Friday as far as the labor market goes, it was Canada as well. So their employment report came out. If we take a look here, the unemployment rate actually from in July was 6.9%. The expectations was 7%, and it came at 7.1%. This is climbing. My number here is 8% when everybody starts to freak out about the unemployment situation. But we are on that trend upwards. If we take a look at the net change in employment for July, it was down 41,000. Now, the Canadian numbers can be lumpy, every back and forth, up and down a little bit, and you have to look at the overall trend. But that was a bad number back for July. And then the expectations was for a slight build to 5,000 in the month of August. It came in at a loss of almost 66,000 jobs. Yes, 66,000 jobs. So we had two big negative months back to back. Now, don't forget, we had that GDP come in the previous week on a quarter-over-quarter basis for Q2. Canada lost 1.6% for GDP. Now, these numbers are not good. So the economy looks like it's slowing down. Unemployment's starting to tick up here as well. This is not a good sign. Now, this isn't all from tariffs. We've seen the trend build over time here. Tariffs are still going to be coming in to have an impact very shortly. So it's likely to get a little bit worse here. Here's the unemployment rate for Canada. We're going back a couple years here, and you can see the trend definitely has been higher overall. And like I said, once we start to get close to that 8%, I think that's when everybody starts to get a little worried here. Maybe when we get past that 7.5%. But we'll start to see a little bit of worry coming in. We're starting to see more and more layoffs in Canada as well. Okay, so let's take a look at some of the price action last week. We saw the S&P 500. It was up just marginally, 0.3%. Communication services was up huge. Google did very well last week on strong earnings, so we saw that stock really drive that sector higher. The technology sector was up marginally as well. Energy was down 3.4% last week. The utilities was also down 1%. So a little bit of a mixed picture last week. It really did come down to the communication services really driving the S&P 500 here at this point. If we take a look at some of the international markets, well, first of all, I want to take a look at small caps up 1%. Now, that was partly because we saw the interest rates adjust downwards in the 2-year, et cetera. And so that's a little bit of a knee-jerk reaction. The small cap market benefits from lower interest rates. It's one of the sectors. The TSX was up 1.7% last week. Now, that's interesting because energy didn't do well last week. So it's the other sectors of the market that were pushing it higher. China did well. Emerging markets did well. Once again, Dow Jones a little bit down last week. If we look at some of the sectors in the market here, we can see gold miners up 5% last week, 4% for gold. So this is another huge move. Gold's been on fire. So have the gold miners as well. Home builders was up 4.7% last week. That really was a knee-jerk reaction once again to lower interest rates. That sector does benefit from lower interest rates. Transportation down 1.4%. If the economy is good, you expect the transportation sector to do well. And for those that follow the Dow Jones transportation timing signal, it's an older signal from, well, back many decades ago, and some people still follow it. Typically when the Dow Jones makes a new all-time high, you want the transportation sector to follow along, and that hasn't happened yet, which does show a little bit of weakness in the market. Now, it makes sense. The transportation is a measure of economic health. If we're transporting a lot of materials back and forth, then that does show signs of economic strength. Now, today's economy is different than it was back, let's say, 40, 50 years ago because we're more services-based, but I still think it's something to look at. This graph shows the sectors of the market. I'm using the S&P 500 GICS for the TSX, so the Canadian stock market here. Maybe I'll drill down a little bit more next week. Technology was up, and so it's really sometimes just a few stocks that drive this, and we'll start taking a look and seeing what sectors or what stocks are actually driving these numbers here. Materials, that's actually mainly gold miners is the biggest component of that, so gold miners doing well. In Canada, pushes that higher. Energy was down just like it was in the US. So talking about gold miners, this is the reason why gold miners have been doing really, really well. If you take a look here at this graph here, these blue bars are the all-in sustaining costs, AISC, and it's 1,533 for the cost. They have been rising, but look at this for the price of gold. It's been going way up. So this differential between the gold line there and these blue bars is the profit margin, the production margin for these gold miners. And that's why gold miners have been on fire, because as the gold price moves up higher, they're leveraged to this lower price for their costs. So they've been on fire mainly because they're just getting so much more cash with costs not rising nearly as much as the price of gold. Okay, so what should we expect in the markets this week? Well, the earnings season really is winding down. There's not that many companies reporting earnings. We are almost a month away from the next earnings season. So it really comes down to economic reports driving the market. And it is a busy week, as you can see here. But it really comes down to I think the CPI number this week. That's really going to make or break the market. If we take a look at inflation here, this week it's the CPI coming out year over year. Previously, for the month of July, it was 2.7%. Expectations are for 2.9%. That's not 2%. That looks like it's heading the wrong way here for the headline number. It's closer to 3%. Inflation really has been struggling to go down. And if we take a look here at the core rate here, we can see the core rate previously was 3.1%, expectations 3.1% again. This is what the Federal Reserve really concentrate on. Once again, that's not close to target. And this is, 3% is not a low number here. And so this is going to really, could cause some problems for the Federal Reserve. And I think this is going to be the key number this week. If we take a look at what's taken place, if we go back to the Jackson Hole speech, Powell said that, previously we were focusing on inflation. Now we're focusing on unemployment because that's where we see some really weakness underneath. And I agree, that's exactly what's taking place. The unemployment rate, 4.3%, doesn't really show the full amount of the unemployment situation because there's a lot of other stuff going on. And I don't want to get into all the politics of how inflation is measured or unemployment is measured. And there's a lot of movement of people and all that sort of stuff. But we're seeing some of the measurements here. They're saying, look, the labor market's not very strong. So I think the labor market deterioration has given the Federal Reserve permission to cut rates. The inflation market is going to either give permission to cut fast or slow. So the labor market saying, yes, we give you permission to cut, and the inflation market's going to say, well, how fast do we go? I think this is probably the way the scenario works out this week. If inflation comes in higher than expected, the Federal Reserve still cuts, and then they come out with a hawkish message after. And I think you'll start to see, well, some of the media reports, do we have stagflation? Should we worry about stagflation, et cetera? And I don't think the market will like that at all. And I think that could have a huge negative impact on the market. On the other hand, if we see inflation come in much lower than expected, I think that all of a sudden the market will cheer and say, yes, we're killing inflation here, so the Federal Reserve can really start to pick up its rate of pace of cutting rates. And the market actually could have a very strong bounce from that. So I think we're going to see a big move one way or the other on this, unless we come in really close to the expectations, which is possible as well. So it's really coming down to this number. Now, I have to go back to what happened last Friday. If we take a look at what took place as far as the non-farm payroll reports, they came in weaker than expected. Initially, the market cheered that report. We saw the market in the morning, the first half an hour, 3/4 of an hour, rocket higher. And then all of a sudden, investors started to go, oh my goodness, well, if the unemployment's not so good, that's not good for the economy. Maybe we're slowing down here. And maybe we should worry about the slowdown more than the fact that the Federal Reserve's already going to cut anyhow. We know that, so does it really matter that much, at least in the short term? And so we saw the market pull back from that. Not a huge amount. It did come back a little bit at the end of the day, but was negative for the day. That's a sign that the narrative is flipping, and investors are getting concerned about, the economy overall. They haven't been looking at it recently that much, but they're starting to worry about, well, maybe we are starting to see some other underpinnings as far as what's measuring economic health here. And I think the downside for the market, if we come in with a higher inflation number, is much bigger than the upside if we come in with a lower inflation number as much as pushing the market higher. Because I think investors will really start to worry and say, yes, the economy is slowing down, and the Federal Reserve really can't go that fast. It's going to be an interesting week. Thank you very much for joining me today. Please like and subscribe to this video and channel. Thank you very much.